The Trump trifecta of terror, AMP, is it a dog that's about to have its day, or are you in the situation where you'll be catching a falling knife? And the Paul Rickard Peter Switzer masterclass of investing. What will we teach you? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. I nearly mucked up that intro, didn't I? Okay, the Trump.
Well, you did muck up the intro, Peter.
A little bit.
Let's move on, anyhow.
The Trump trifecta of terror. Okay, I'm saying there's three events coming up, and Paul can comment on them. First one is, if there is no trade war truce, problem for stock market. And
big problem for stock market. Keep going. Yep.
Okay, next one. The next one.
The rate cut.
The rate cut. If the Fed doesn't come through the rate cut, I mucked that one up as well. That will be a really big problem.
Well, 100% of analysts at the moment expecting a rate cut. The Fed meets 31st of July, so we'll hear about it, I guess, on the 1st of August. But if they don't cut, you're right, Peter. So, look, the markets, it'll send...
On a knife's edge, again.
In the same way, you look at what happened. I mean, we go back as little as middle of December last year, the market was still expecting 3 rate increases in the US this year. Then the Fed started using the word patience. On the 20th of December. Now everyone's expecting rate cuts. 2 or 3 cuts this year. They don't do it announced at the Fed meeting in July. The market's going to have all sorts of... It's going to turn itself upside down.
Yeah, okay. And the final one, this is a really interesting...
And that'll affect your super. That's why it's such a big thing.
And it could be a recession created, and therefore your jobs and your business or whatever. But the third one is US companies and their bosses don't like picking on Donald Trump because Trump gets even big time. But if their company is doing badly because of the trade war, under stock market rules, they have to fess up. So this could be an opportunity for CEOs to take on Donald Trump. But if the news collectively is bad, the stock market could sell off, couldn't it?
Well, and this is really important because we're just starting US earnings season. This is Q2 earnings. Expectations are around about a 2 or 3% fall. So far, the first 5% of companies have been okay, but it's early days. Why this is important, Peter, is because tariffs are taxes. People forget that a tariff is actually a tax. So it increases the cost of goods coming into America. It means it's more expensive for those manufacturers to sell their goods. And there are expectations, which we know a lot of the companies, particularly in Midwest America, are doing it pretty tough because of the trade war. So it's having an impact on the economy. So look, we're going to see with the relation back to earnings is people have to explain why the earnings are down a bit. They have to give an outlook statement. And if they start to say, well, the tariffs are really starting to hurt our business, Donald won't like it. So it puts the CEOs in a bit of a straitjacket, but I think this is really important for the market. I mean, the market's at record highs. It's not at record highs because it's earnings. It's at record highs because of interest rates. It now needs to get some earnings to that aren't too bad to at least sustain some of the momentum.
Okay. All right, let's go AMP now. Is it a dog? I love dogs. Relating a bad company to a dog, I don't like that, but still people do. A dog is about to have its day, or is it a falling knife that we should not be trying to catch?
Well, look, I think you accused me of mixed metaphor.
It's a mixed metaphor.
I don't think it's a mixed metaphor.
Dogs and knives don't go.
They're used in very different parts of the same sentence. I mean, every dog has its days, an adage that's been around since day one.
Yeah, but every dog doesn't have a knife.
And never catch a falling knife is another adage that's been around since day two. I have to say, I think AMP is still probably in the falling knife category, Peter. Look, there is a valuation that AMP is worth in terms of you could break it up. I mean, potentially it's got a very profitable bank that's worth something. It's got a funds management business, AMP Capital, although it's having some outflows. There's still got some good products in that, and that's worth something. It's also got this life insurance business and a wealth management business. So the sum of the parts valuation probably says it's worth more than the current share price. But AMP is not being broken up. Market's a bit concerned that with this ruling in New Zealand, that increases the prospect of a capital raising. A lot of the analysts are now talking about a capital raising. I think it's too early to get into AMP. I know people are tempted. I said the same when it first dropped.
If you're a punter, you would. If you're an investor, you wouldn't.
Well, I think even a punter, you'd still be pretty careful. I think we're not going to see a sudden turnaround. The problem with AMP, and you've got to remember this, it takes a long time for investors to react to all this bad news. And what I mean investors, these are people who've got superannuation monies, companies who've got a corporate superannuation funds, investors who've got monies in various AMP products, financial planners who've been recommending AMP products over many years. The outflows are big, and the outflows are still there. And while the outflows are occurring, it's going to be really hard for AMP.
And the problem is some of their products are actually good, but a lot of clients to financial planners will say, I don't want to be a part of AMP. They look
AMP,
really dodgy.
You know, it broke all the trust rules in the business.
Yeah.
I don't think David Murray and his team have yet got the answer, and this is a knockback. So, look, I'm not saying it's a sell, but I think I'd be wary. I don't think this is one to have your two bobs punt on just yet.
Let's talk about our masterclass. So this is going to be held on August 16 in Sydney, 20th August in Melbourne, and 21st in Brisbane. First half of the day, we've got some of the hotshot fund managers and really insightful people.
We've got Jeff Wilson coming, and look, he's going to be really exciting to find out. Particularly, he's sort of the doyen of the listed investment company, listed funds industry.
Smart investor.
And very responsible for some of the debate around franking credits. So Jeff will give his thoughts on some of the changes and what we'd like to see in that industry.
Yeah, so that's the first half of the day. And the second half of the day, Paul and I are basically going to do a show and tell on what we think is really important when it comes to investing.
Well, let me fire off first, Peter. What are you going to show and tell about?
Well, I think one of the important lessons is always around time in the market and timing the market. And people will always like the idea of timing. But the bottom line is, if you look at the academic work that's been done on stock markets, it actually shows that you are better off being in the market over a long period of time and not trying to guess when a market's going to crash. And because what happens is you tend to be out of the market on some of the best days when the market goes up.
But you're a buyer of the market at the moment, are you?
No. And but the interesting point I'm going to say is this. If you're already in the market, I wouldn't be getting out of the market yet. And look, I might actually help people time the market. But it's risky. That's the point I want to make. And if I was a young investor who had never been in the market before, I think I would wait for the market to crash because I'm not in the market. I've got no exposure. But when it does crash, then I would go in and buy great quality companies. And classic case is CBA was $27 in the GFC, and what's it now? $80 odd, and it's yielding about 17%.
Well, I'm going to talk about a couple of things, Peter. I'm going to talk a bit about portfolio construction. I still think that's the secret for most investors. But I also want to talk about some of the adages. I'm a firm believer in some of these rules, and that's one of the reasons we had the mixed metaphor up front.
Yeah.
Okay, every dog has its day, plus don't catch a falling knife. But you know, the hardest thing in the market, you see it time and time again, is things like getting out of bad positions. Yeah. And
selling. Your first loss is your best loss.
That's one of my favourites. Your first loss is your best loss.
Whatever that means.
And it means, look, if you got it wrong, just admit you got it wrong and get out. Yeah. You don't have to buy back in. You can always buy back in, even at a higher price, and say it was the wrong thing to get out. But sometimes just the clarity of being able to say, that's the wrong decision, I need to get out. Let's sit back, reassess. It just feels so much better. So, look, I want to go through some of those because they are truisms and they are repeated time in, time out. Yeah. That's what we're talking to you about our Investor Masterclass at our listed investment conferences. Peter said it. Sydney on the 16th of August, Brisbane on the 21st of August, and I got it around the wrong way, Melbourne on the 20th of August. I reckon I did that better than you, Peter.
No, I don't think so. Anyway, I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.